Another product I will introduce you to is Adobe. Adobe had a review day a few weeks ago and we thought it would be fun to write an article covering the most interesting ways. Note that Adobe is currently immersed in rapid changes in generative AI, which means that there is new information almost constantly. We don't feel comfortable with the industry moving too fast. But we think that Adobe is moving forward in the space AI is creating and it can be a profitable business. We will give our opinion about moat in this article, because now it is clear that it is changing. It was a special day for Adobe analysts as management focused on innovation rather than financial metrics and details. Of course, there is a discussion around the amount of money. Without further ado, let's jump right into the highlights of the day from Adobe researchers. Adobe's team has long talked about generative AI, especially its growth potential and how they plan to invest in it. It is now clear that Adobe will benefit from two main factors driving the AI investment boom. Management also gave us some promising details. First, the next quarter is expected to be the company's first quarter over $5 billion in revenue. This is a significant step, but it seems that the company will be able to move forward. Dan Durn, Adobe's chief financial officer, did not give a timetable but said $30 billion in revenue was on the horizon. The next stock that I will present to you is ExxonMobil. My last bullish thesis on ExxonMobil has aged well as the stock significantly outperformed the broader U.S. market over the past quarter. Today I would like to reiterate the strong buy rating for XOM and explain why I am still bullish. The valuation remains very interesting, with the potential to reach 20% under the conservative assumption for my discount simulation. Management made the necessary decision to acquire Pioneer Natural Resources, which can create long-term value for shareholders. I also like that the management is not only focused on financial growth, but also prioritizes organizational savings. The latest quarterly results were released on October 27, when XOM missed the consensus estimate. Their revenue decreased by 19% annually, which I did not expect due to the increase in the price of energy goods in 2022 caused by the war between Russia and Ukraine, which began in February 2022. Net income followed the decline in revenue, with adjusted EPS falling from $4.45 to $2.27. Oil and gas prices are highly volatile and affect investor sentiment towards energy companies, especially giants like XOM. For potential investors, it is important to understand that the price of oil and gas depends on many unpredictable factors that affect the required equity. Geopolitical events and the decisions of the minority in charge of the oil industry of the exporters greatly affect the market's expectations regarding the supply capacity or imbalance. As a company that owns and operates a large network of facilities, including refineries, chemical plants and mining operations, XOM faces significant operational risks. All these facilities require continuous maintenance to ensure smooth and efficient operation. Failure to do so may result in operational disruptions and safety hazards. This can lead to costly downtime and can result in financial and reputational damage to XOM due to lawsuits and fines. To conclude, XOM is a strong buy. The stock is highly valued and offers a solid dividend yield of over 3.5%. The company is showing exceptional value and its recent announcement of the PXD acquisition is also a good sign for investors. XOM has expanded its product portfolio with high-quality equipment and great value, which will likely bring many synergies for the combined company. I appreciate management's strong commitment to reducing costs by improving operational efficiency. Another name I will bring you is Live. Shares of Livent Corporation, a conglomerate that sells lithium products, have struggled over the past 6 months. At a time when large markets saw a mid-minute return, LTHM stock fell -36%. Feelings for Livent products have changed for a number of reasons. First, there is a significant decrease in the electric vehicle sector, and LTHM, which is one of the suppliers of lithium hydroxide batteries for the production of cathode materials, may be greatly affected due to the space where these materials are located. are often used. It can be argued that in today's tight financial environment, few EV buyers can afford high-performance EVs. These cars usually use high-density batteries, whose cathodes have a high nickel content. These are also the types of batteries that focus more on integrating the benefits of lithium hydroxide. Recent industry reports from Asia show that lithium hydroxide has been heavily affected by the weakness of NCM batteries. For most of 2023, investors who are looking for a suitable conversion opportunity in a wide horizon will not be able to search for the Livent market, but now, once again, the opportunity has opened. Currently, Livent's strength against all factors is 35% below its long-term average and could benefit from some reversal. In the weekly chart of LTHM, we can see that things are not going in the right direction now, since the stock is falling to a strong limit since mid-July. However, there are reasons to believe that the situation may change soon. First, this product is now in the middle of the floor that used to work as a positive restriction zone between February and July 2021. Second, the RSI indicator of 14 times is also on the verge of reaching the limit. That's not to say we'll necessarily see a V-type reversal, but we think the sell-off could soon expand to current levels, opening up some good opportunities to stockpile the stock. What also supports the purchase is the fact that smart money does not stop at this story. On the contrary, in the last 6 months, they have increased their total net worth in LTHM by 2%. To conclude, we think it is a good opportunity to join LTHM. The product is buy. Another thing to note is the cost-effectiveness of LTHM's operations, even in FY25. Before we get into the plans for FY25, it is important to consider. And the lithium space is filled with many small players not involved in China and Africa, who are struggling to extract the raw materials well and poorly in the global price system. Therefore, these companies are not well positioned to put their foot on the pedal when it comes to expansion plans. When the cycle goes wrong, their cost structure will force them to stop production or go out of business. An integrated company like Livent can weather these adverse weather conditions while still providing the ability to operate efficiently. Investors should also know that LTHM does not depend on spot prices and has a good number of long-term contracts that provide stability and good visibility. Interestingly, management has confirmed that some of its multi-year customer contracts before 2021 will soon be renewed, giving them access to higher prices for FY24 and beyond. Overall, if we take the previous year's revenue and EBITDA numbers and look at the sales estimates in FY25, you are looking at a company that continue to achieve 20% CAGR by FY25. And even better EBITDA CAGR of 26% in the same period.